Good morning, ladies and gentlemen. Thank you for joining us today for the presentation of the OECD's latest economic outlook. I'd like to mention there is a simultaneous interpretation available here in the room. You have devices below your seats. I would just note that channel 1 is English, channel 2 is French, channel 3 Spanish, channel 4 Italian, channel 5 Japanese, channel 6 Vietnamese. I'd also like to say today's presentation will take part in two presentations. We'll have one from the OECD Secretary General, Matthias Cormann, followed by the Chief Economist, Alvaro Pereira, after which we will go into Q&A. Thank you very much.
Good morning, everyone, and thank you for joining us for this launch of the OECD Economic Outlook. Through to the end of 2024, the global economy showed real resilience, with GDP growth of 3.3% for the year. But the global economic environment has become significantly more challenging since. From January to March this year, GDP growth across the OECD area dropped abruptly to 0.1% over the previous quarter, the slowest rate of growth since the peak of the COVID-19 pandemic some 5 years ago. Bilateral tariff rates between the United States and its trading partners have risen sharply, with significant consequences for growth and for inflation. Measures of trade policy uncertainty based on print media have increased to unprecedented levels. Near-term indicators point to a weakening of economic activity, with surveys showing declining consumer confidence, with policy uncertainty also undermining business confidence. Since our last interim outlook, we have further revised our projections for global GDP growth downwards. Global growth is projected to slow from 3.3% in 2024 to 2.9%, both for this year and next. This is down a further 0.2 percentage points for this year and 0.1 percentage points for next year compared to the March interim outlook, and it is 0.4% down for both 2025 and 2026 since our economic outlook 6 months ago in December 2024. Higher trade costs are contributing to renewed inflationary pressures. We expect inflation in G20 economies over this year and next to decline more slowly and remain higher for longer than previously foreseen in our December 2024 outlook. Turning to some country-specific developments. In the United States, growth is expected to slow. The main headwinds are lower export growth as a result of retaliatory measures from some trading partners, the impact of high policy uncertainty, and a marked slowdown in net immigration. US GDP growth is projected to decline from 2.8% last year to 1.6% this year and 1.5% next year. In the euro area, growth is expected to strengthen modestly from 0.8% in 2024 to 1% this year and 1.2% next year. Improved credit conditions as a result of monetary policy easing and increased investment from next generation EU funds will help offset the impact of pressures on trade. In Japan, strong wage gains and business investment growth are supporting activity. Growth is expected to improve from 0.2% last year to 0.7% this year, and then to moderate to 0.4% in 2026 due to more subdued external demand. Emerging Asia, that is China, India, Indonesia, and 7 other dynamic Asian economies, continues to account for more than half of global growth. Still, the increase in tariffs will weaken growth in China, while fiscal measures such as subsidies for consumer goods help cushion the slowdown. We expect growth to moderate from 5% last year to 4.7% in 2025 and 4.3% in 2026. There are significant risks to this economic outlook. The outlook for trade and trade policy is particularly uncertain. Additional increases in trade barriers or prolonged policy uncertainty would further lower growth prospects and likely push inflation higher in countries imposing tariffs. Our report estimates that in a scenario in which US bilateral tariffs are raised by an additional 10 percentage points on all countries as compared with the rates in force as of mid-May, global GDP would be about 0.3% lower after 2 years. Canada, Mexico, and the United States would be particularly affected given their close economic and trade integration. On the flip side, though, on the upside, measures to reduce trade barriers or to resolve concerns about aspects of the global rules-based trading system on the basis of keeping markets open and maintaining and preserving the economic benefits of open markets and rules-based global trade could lift sentiment, lower trade costs, support growth, and help ease inflationary pressures. Persistent inflation remains another key risk. Goods price inflation ticked up at the beginning of the year, primarily due to rising food prices, while service price inflation has remained relatively high. Inflation expectations by households have moved up in some countries, particularly the United States, likely related to an increase in expected costs for imports. Higher inflationary pressures would require monetary policy to remain restrictive for longer, raising borrowing costs and slowing economic activity. So the key policy priorities in this context: constructive dialogue to ensure a lasting resolution to current trade tensions, prudent monetary and fiscal policy, and ambitious structural reforms to reinvigorate longer-term growth. In relation to the higher trade policy uncertainty and tariffs over the past few months, our key recommendation to all governments is to engage with each other to address issues in the global trading system cooperatively, to talk the issues through among market-based democracies and beyond with any partner countries around the world prepared to engage in good faith conversations about how best to make the global rules-based trading system fairer and work better for everyone. The OECD is in many ways a perfect platform for some of those very important multilateral conversations. And to put some numbers around the opportunity, according to our analysis, a broad-based global decline of tariff rates by 1.5 percentage points could boost global GDP, could boost GDP by 0.2% in G20 advanced economies and almost 0.3% in G20 emerging economies within 3 years, while also helping to bring inflation down. The OECD's unique data analysis, standards and tools in areas ranging from market-distorting subsidies to the importance of competitive neutrality, sound corporate governance of state-owned enterprises, and responsible business conduct can provide important input into key bilateral and multilateral conversations about improving global trading arrangements. Monetary policy will need to be carefully calibrated. Central banks should remain vigilant in view of the high policy uncertainty and the potential for higher trade costs to affect wages, prices, and demand. If inflation expectations remain well anchored and trade tensions do not escalate, policy rate reductions can continue in countries where inflation is projected to moderate or stay subdued. In our projections, we expect continued policy rate reductions in several large OECD economies, including the Euro area, the United Kingdom, and the United States. On fiscal policy, governments need to focus on rebuilding fiscal space and on preserving room for future spending pressures. Last year, public debt in the OECD stood at 112% of GDP, up from 73% in 2007. And debt servicing costs are on the rise. Our global debt report released in March shows that government interest payments increased as a share of GDP in about 2/3 of OECD countries last year, reaching 3.3% on average. In parallel, defense spending requirements have been increasing in Europe and elsewhere, though it is still below countries' own targets, forcing difficult choices about the pace and the composition of fiscal adjustment. Pension and social policies, for example, the two largest items in government budgets, could be made more effective through better work incentives for older workers and targeting of social benefits. While responding to the immediate economic challenges, we must also lay the groundwork for stronger growth prospects in the medium and long term. Potential per capita growth for the OECD this year is estimated at 1.3%, which is down from around 2% in the 1990s. Job creation has been a central driver of growth in recent years, while productivity growth and investment have both declined significantly. Ambitious structural reforms are key to unlocking higher investment and productivity, ensuring they once again become stronger drivers of growth, including by boosting competition and reducing barriers to firm entry, lowering regulatory costs for businesses, reducing policy uncertainty, improving opportunities for financing, especially for young, innovative firms, and ensuring a skilled, flexible, and adaptable workforce. In closing, while we're facing significant economic headwinds, we have the tools to make progress on key structural reforms, support productive international cooperation for greater policy certainty, and foster strong, sustainable, inclusive, and resilient growth. Thank you, and with that, I pass the floor to our Chief Economist, Alvaro Pereira, to present some of the details of our analysis underpinning this economic outlook. Thank you.
Good morning, pleasure to be here. Just would like to first thank the teams that work on this economic outlook, in particular the MPR team and also all the economics department and the desks. So the overarching theme of this economic outlook is tackling uncertainty, reviving growth. We have significant, unprecedented, as we just heard the Secretary General, uncertainty surrounding economic policy, trade policy, and this is having significant repercussions as well in our indicators. So we saw from the Secretary General's presentation that consumer confidence is coming down, but if you look at business confidence and other activity indicators, like the PMI composite output, you can see that in countries like Canada, Mexico, Spain, the United States, and others have experienced a decline in their activity indicators. The same thing, as I said, for sentiment indicators. One of the reasons for this is, as I said, trade uncertainty and the significant change in trade policy in the United States. Basically, this graph tells you the average effective tariffs in the United States in the last 130 years. You can see that if you take into account right now the assumption that we make in this economic outlook, which is basically tariffs from May 14th or mid-May go forward, you can see that basically the average tariff rate for the United States right now is the highest since 1936. And if you take this to the April 9th tariff announcements, then it would be the highest since the 1890s. These have significant implications, as we saw, for consumer, for investor, but also the question is, will it happen for trade? Well, in the first quarter of 2025, in fact, trade was fairly resilient. We had the largest quarter of trade growth in the last 4 years. And this is mostly because a lot of firms in the steel sector, aluminum, pharmaceuticals, front-loaded their exports to the United States to try to avoid these tariffs. That's why the trade growth has held up and has been fairly resilient. But we expect that there'll be some adjustment, even though trade growth will be around 2.7% this year, which is about a percentage point lower than we had forecasted, as we'll see later. So all these consequences, lower confidence in consumer, lower confidence for investment, the uncertainty surrounding trade and economic policy is having also a consequence. And we, because of this, we also downgraded our forecasts for the world economy. So as we heard, right now our forecast is a growth of about 2.9%. But the most important thing, if you see this graph, if you see this table in terms of numbers, and you see the next, which is basically gives you the G20, non-G20 economies, it doesn't matter if you are a G20 economy, a non-G20 economy, if you are big or if you are a small economy, if you are open or relatively more closed, we downgraded almost everybody in terms of our forecasts. Just noticeable exceptions with Argentina's recovering from significant crisis. The adjustment, the structural reforms are paying off. Inflation is coming down, and this is having a positive consequence. And in other countries, either because of particular factors, there's been an upgrade, but basically we downgrade almost everybody. In terms of inflation, as we just heard as well, we expect inflation will stay higher for longer periods of time. We expect, for example, in the United States, inflation will reach close to 4% at the end of the year, and then will come down next year. But for most countries, inflation will stay a bit higher for longer because of all these factors, even though we do think that by the end of 26, they'll be closer to their targets. In terms of risks, we first started with the risk of further trade fragmentation will harm global growth. So we have a simulation in which we say, if we have additional tariffs, about 10% from the United States vis-a-vis the rest of the world, what will be the consequence? And the first consequence is what you see in the red column, basically direct impact from tariffs in terms of output. Remember, tariffs usually tend to increase intermediary inputs and also other factors in the economy. And so tariffs will have an impact, but then afterwards, there'll be additional impacts, which is impact on equity markets, usually go down, increases in savings. And so this is what you see in the green and orange line. So the overall impact for the United States will be about, after 2 years, about 1.6% growth less, and for the world, less than 1% growth altogether. So this is a significant risk. Now, this is very important to get trade agreements, get to the table, get trade agreements so that we avoid further trade fragmentation. And in fact, we lower trade barriers. On the other hand, we also know that, as we saw in the presentation of the Secretary General, debt levels are fairly high. And in fact, not only debt levels are already very high, but also spending pressures are rising. So we have defense expenditures that are rising. We have expenditures related to the green transition that also are quite important, and they are rising. And on the other hand, we also have spending associated with the aging costs. Aging is one of the big advances of humanity. We are getting, in terms of life expectancy, 2 years per decade. But if nothing happens, if policy stays unchanged, there will be a significant cost. And here you have the cost for your economies in terms of pension expenditures, long-term care, and also health expenditures. And for certain countries, this is a big item and will add to the spending pressure. So basically, these future spending pressures obviously pose a significant challenge for public debt sustainability, and this is a risk going forward. On the other hand, we also know that tighter financial conditions have a significant risk for many low-income countries. In particular, as we see in this graph, and as Secretary General mentioned in our debt report that was launched in March, you can see that about 40% of debt that will be refinanced and needs to be refinanced in the next 2 years is from highly speculative debt. So, there's a risk that refinancing might be difficult for some of these countries. And on the other hand, in terms of financial market as well, there's historical elevated valuations in many of these equity markets. And so if there's a shock, a negative shock, might pose a vulnerability going forward. So what type of policies, since we have these conditions, what type of policies is the OECD recommending right now? So first of all, first and foremost, top policy priority, negotiations and especially trade agreements, dialogue going so that we are able to lower trade barriers. In this graph, what you can see is the OECD forecast in December for trade growth compared to what is our forecast right now. You can see there's a big gap between the two lines. We are revised down significantly our trade growth projection, and this means basically if instead of having additional trade barriers, if we lower trade barriers, as we saw the simulation before, we'll have a positive impact on growth. On the other hand, monetary policy needs to remain vigilant, since now we have an environment in which goods price inflation ticked up a little bit, service price inflation continues to be fairly sticky, at the same time that we have additional pressures from the tariff environment. So basically, monetary policy needs to remain vigilant going forward. And on the other hand, given the big spending pressures and the high debt that we have in the world economy, it's quite important to be able to take some fiscal action and go back to fiscal discipline for many of the countries. We don't expect significant fiscal consolidation for most of the countries that we follow. Having said that, we do think that, first of all, in this graph you can see what your average country is spending on the different items, and we think in many of these items it's possible, if you undertake spending reviews, to find spending efficiencies, but more importantly, we also think that it's quite important to strengthen medium-term frameworks, so fiscal frameworks in the future. Don't look only at the short run, think about medium and long term. What are the consequences? So establish these medium-term fiscal frameworks, introducing, if you don't have them, independent fiscal institutions, and also broadening tax bases and lowering rates sometimes, depending on our circumstances, might be a good option going forward in terms of fiscal. Above all, we think that right now, in order to revive growth, you need to do one thing that is absolutely essential, which is revive investment. So in our special chapter, we have a lot of evidence, new evidence in terms of investment. And first of all, we know that investment is one of the contributing factors for lowering the output growth, potential growth in the past few years. So in the blue columns, you see investment there, and productivity has come down, but in particular also investment has been fairly weak after the financial crisis. And you can see this particularly in these graphs that show what happened after the global financial crisis and after COVID. So the actual investment line is the blue line. The dotted line is the trend that existed in terms of investment before the global financial crisis. The dotted orange line is the trend that existed before COVID. And for OECD countries, investment went down by an average 22% after the global financial crisis, and went down in terms of business investment, in terms of housing investment, and in terms of public investment. And with COVID, another additional 7%. So we have a big two cuts in terms of, or declines of investment after the global financial crisis and after the COVID, and for emerging market economies even more, a 33% decline in investment. So reviving investment is absolutely key. What type of investment? Well, investment is changing. We present a lot of evidence. A lot of investment right now, rather than be traditional capital stock investment, is mostly investment shifting towards more digital and knowledge-based economies. Here we have several items in terms of ICT, in terms of research and development and software. The United States is investing a lot more in these areas than almost everybody else, and this has big consequences not only for investment but also for productivity. In recent work, we showed for the G7 economies that there's a widening and increasing divergence in terms of productivity between the United States and others. But investing in ICT, investing in R&D, investing in software and data is going to be absolutely key to revive investment in your countries. On the other hand, housing investment has been very weak. In many of your countries, there's significant issues regarding housing affordability. House prices went up quite significantly compared to income growth. And this is seen in the graph here, where you see countries like Portugal, Canada, the United States, Netherlands, and others, in which house prices since 2015 increased a lot more than income growth, and so housing affordability issues became quite prevalent. So very important to increase supply, reducing zoning restrictions, permits, to increase supply, densify cities to be able to address these housing affordability issues. We have several analyses and several recommendations in our economic outlook, but this table basically summarizes the main recommendations we give to your countries and in our country notes. We think that in terms of reviving investment, you need to boost competition, also increasing public investment, in particular in areas like energy security, critical infrastructures, strengthen transportation networks. All that is going to be very important to boost public investment. Also, addressing skill shortages. If you remember, last economic outlook, we said that there is, in more than close to 40 countries, significant skill shortages around the OECD. And so it's absolutely essential to address these skill shortages to improve investment, but also other recommendations on housing and on financial markets and so on. Let me sum up. So remember, we are in an era of very significant and unprecedented uncertainty. This is having an impact for consumption, for investment, and for activity. And that's why we downgraded most of the outlook for most of the countries. In terms of policies, the most important one, remember, the top policy priority is to lower trade barriers so that we are able to boost growth and have less inflationary pressures. We also think that it's quite important for fiscal discipline to come back to some of the countries to ensure fiscal sustainability. Vigilance in terms of monetary policy, but the most important factor in terms of reviving growth is to revive investment. Investment policy should be a top priority for the medium and long term, and we hope that our recommendations are able to provide shed some light on these issues for countries. Thank you.
Thank you very much, Alvaro, Secretary General. We'll now move to questions for those here in the room. For those online, please feel free to put your questions into the Zoom. We'll try to get to some of those, but here in the room first, we'll go right there. Please introduce yourself.
Ángel Calvo from the Spanish press news agency EFE. Your outlook is clear about the effects on the short term for the US and for the other countries. Because of the Trump tariffs, but in the long term, what can happen? I mean, Donald Trump can success to relocalize a part of these imports which have now tariffs, and in the other side, what will happen with all these products that in the past went to the US, and because of the tariffs, for example, Chinese products or other, cannot go to the US, where these products will go and which will be the effect?
Well, I'm going to ask Alvaro to complement my answer, but let me just reinforce the point. The best possible forward trajectory and the best possible direction will be one based on a dialogue, bilateral and multilateral dialogue, and sharing the diagnostic of what the challenges and issues are in the way the global rules-based trading system is working at present, and to come up with the best possible ways to make international trading arrangements, global trading arrangements, fairer and work better, while preserving the unquestionable economic benefits of open markets and rules-based global trade. The efficiency benefits, the benefits in terms of innovation, competitiveness, driving costs down, ensuring that consumers and businesses have access to the highest quality goods at the best and services at the best possible prices, and indeed, driving increased incomes, driving lower costs. Now, there are some real issues to be tackled in terms of the way global rules-based trading arrangements are currently working. There are things to be done to improve economic security, to increase the resilience of supply chains, to improve the global level playing field. But the best way to do it is, in particular, for market-based democracies to work together on the best possible ways forward, and for market-based democracies around the world to engage with all other countries committed to reform global trading arrangements in good faith to ensure that they are fair and work better for everyone. But Alvaro.
Well, you asked about the long run. Well, in the long run, productivity growth is going to make all the difference. And so countries that are able to revise their productivity and are able to become more innovative and continue to be on the technological frontier will be the ones that will do better. In fact, that's why in recent work that we've done in terms of the impact of AI, which is a general purpose technology, will have a significant impact across the economy. One thing that we see is that right now there's a widening gap in terms of productivity growth between the United States and the rest of the OECD economies. And we expect with the artificial intelligence and the development and the investment in new technologies that the United States, as I just showed, is leading, we expect that this productivity gap will widen. So it's very important for countries around the world, if they want to revive their productivity, to bring more investment to the table, investing in this type of technologies, accelerating in the investment in addressing skill shortages is going to be quite important. So this is what is going to matter mostly in the long term. You asked about trade diversion. Well, trade diversion happens when they have very often with trade barriers. Usually exporters, if they find that one market closes, they'll try to find for others. So we wouldn't be surprised that that could happen. But we will not speculate on specific markets that this will happen. Thank you.
Looking over here for other questions, please introduce yourself.
Lee Thomas from Reuters. You've substantially downgraded your outlook for the United States vis-a-vis your March interim outlook. Could you walk us through specifically what has changed in your view for the U.S. economy since then? And as well, could you give us your quick take on the U.S. budget legislation going through Congress? Thank you very much.
Well, in terms of the outlook, we know that sentiment indicators of consumption and for investment came down. Activity indicators, I just showed you, also went down. And this is reflected not only in the soft data, but also in the hard data. So basically, what do we expect will happen to consumption and investment going forward? Well, we also know that since March, there's been an increase in trade barriers, and we take this into account in our estimations, not only from our desks, but also from our models, and try to understand what will be the impact. So that's the reason why we've downgraded the United States, like we downgraded many other countries. In terms of the budget, we incorporated the budget forecasts in our own forecasts. So the extension of the tax cuts and all the other tax cuts are incorporated in our forecasts. Thank you.
Looking over here, are there other questions from journalists in the room? I do not see any other questions. Therefore, we will close the press conference. Thank you very much. All the information, the economic outlook is available on the website.